Welcome back to Real Investing, where we talk about real investing for everyday investors. Tim Herriage with
Ryan Harper.
and my friend Jeff. And Jeff, I'm going to dive right in because I love the IRS. How about you?
Oh, everybody does. Who doesn't love them?
Well, I think people don't love the IRS that don't know how to play the IRS
I don't know if I'm
game.
on the right podcast. What are we talking about?
So I'm going to just introduce Jeff. Jeff does cost segregation. And cost segregation is the reason I have not had to pay income tax personally for the last 4 years. And the next several $1 million in personal income I make is going to be tax-free. So that's why Jeff's here. It's actually something my wife tells me I should talk about a lot more on this because there's nothing more powerful, or not more powerful, more liberating, I'd say, than knowing you made a lot of money and then seeing a minus on your tax return and knowing it's legal,
Right.
not illegal, legal.
Well, before we dive in too much, I think it's important to acknowledge that, like, this is something that's been going on forever, and it's only been recently made popular when in the, I think it was the 2015-16 debates with Trump and Clinton, where he's like, yeah, I do it because it's legal. If you wanted me not to do it, change your laws.
Yeah.
You know, so I think...
So few people have noticed what he said during that debate.
Yeah.
That's exactly what he said to Hillary at that time was, basically, I'm using the tax laws that are in place.
Right. And I think people don't realize that how many hundreds and hundreds of thousands, millions of dollars does Trump spend just on his accounting team, you know?
Well, and so being mad that someone takes advantage of cost segregation or the tax loophole, any tax code, would be like being mad at someone for driving 75 miles an hour because the speed limit's 75. And just because you're more comfortable at 45 doesn't mean everyone else should get, because if the law says you can go 75, go 75.
Well, I think we don't even address if it's good or bad. Let's just talk about that it is what it is, you know,
Jeff,
in the popularity of it.
how do we drive 75 miles an hour?
So, great question.
Can we go 8? No, just, sorry.
That's a whole nother conversation and won't have that filmed. But the bottom line is, basically for anybody that buys a property that is like most folks out there that are in the real estate game, they don't want to pay income tax or pay as little as they can legally. And so what cost segregation studies do, for those who may not have heard about it, is accelerate the depreciation, allowing that property owner to reduce their income taxes today. Where ultimately a cost segregation study doesn't give more depreciation, it just gives some of it sooner.
So let's talk about this.
Sure.
It was probably 10 years of me buying houses. I had already bought over 1,000 houses before I really understood what depreciation was. Because as a kind of young Marine, pull string, go boom, right? My accountant said you bought rent houses, you can write off this much of it. And so to me, depreciation was just a write-off for buying houses. I just, to be transparent, I didn't really understand what depreciation was. So maybe I buy a house. The house it comes with land, a foundation, some walls, and a roof, and some stuff on the inside. What is depreciation?
Before we get into the cost seg part, what's going to happen is you buy that house just like you described, and your accountant will sub out a land value. Sub
out means back it out. So I like easy math because I'm an idiot Marine. Pull string, go boom. So the crayon math is it's worth 120 and the land's worth 20. So now they back the 20 out.
Yep.
And the structure is worth 100.
100 grand.
Okay.
Correct.
So even though that doesn't exist anymore in America, but we'll pretend.
Yeah, we'll go with simple math.
Yeah.
Caveman math.
Yeah. Crayon math.
Crayon math, because you're a Marine.
Yeah.
So
the red ones taste better.
I've heard that. Anyway, what will happen is you've got 100 grand in consideration, and that's going to get divided by 27 and a half for your...
And that's called...
Straight line depreciation.
Straight line. So what I learned was I used to think that was a write-off for buying the house. But what I learned, and now I call it, is lazy math.
Yeah.
So basically the IRS says I can say that structure's worth nothing of what I paid for it in 27 and a half years.
Correct. You will have written it down and the depreciation is taken. And I would say potentially that for the accountants out there that haven't explained cost seg to the buyers, to their clients, to their taxpayers that they work for, they're being lazy because they haven't brought it up, because you don't have to write everything off over 27 and a half years.
Because the IRS, I'm trying to, you and I are far too advanced. My wife says I talk way past the average viewer, so I'm trying to, so the IRS believes that a home is worth nothing after 27 and a half years.
Correct.
So if you're listening to this, you just got to understand how stupid that is. Because we all buy houses knowing they go up in value. But the tax code, written by the politicians, because they all own multiple houses, says a home is worth nothing but the land in 27 and a half years.
But that's why there's such opportunity to find commercial buildings, all these buildings, houses at a certain age, because it makes sense to sell it because you're no longer getting the depreciation on it.
Right. So I want to start there. So lazy tax, lazy math, lazy investor, and for me, the first 10 years, ignorant investor. I just didn't know better. You can take the structure and over 27 and a half years on your taxes, make it worth nothing. Cost segregation. Explain to me what that is with regards to the structure of a home.
Okay. And let me throw in one other
Please.
variable that hasn't come up yet, but you threw in the word commercial properties. So everything on the market, everything out there that we look around and see, every building that's for rent is going to be 39 years depreciation, okay? Except apartments or residential rental, which is 27 and a half. So if the viewers are residential rental folks, they're 27 and a half. But every other kind of building out there, whether it's a veterinary practice, office building, hotel, whatever it is 39 otherwise.
So listen to me if you're watching the YouTube video. Over my shoulder is a stadium that cost $2 billion to build. And the IRS believes that 39 years from the day that thing was put into service, it is worth nothing.
Pretty sure it's worth nothing now.
Not if you play there. All right. So
But you're,
I want to stick to
that's the
residential,
premise.
27 and a half
Yep.
years. I can take $100,000 and divide it by 27 and a half, and that's my annual deduction.
Yep.
But what are my other options?
So your other option is to say, wait a minute, there is stuff within the tax code the IRS will allow you to take more quickly. And so what you can do is accelerate the depreciation. I analogize it to basically Tim and Ryan just bought a property and they're driving onto the property. And as soon as they leave the public right of way, the road, and they get onto your property, everything from the moment you leave the right of way is going to be 15 years. So that's the 15-year component.
Driveway?
The driveway, 15 years. The conduit that might take electricity out to the light pole, or it might be a swimming pool or a retaining, pond. If you, depending on where you are, you may have a retaining pond on your property, or a drainage ditch, or fences, or retaining walls. Anything outside of the physical building to the property line is 15 years.
So I want to get to cost segregation in a minute.
Okay.
But we said the 27 and a half was called straight line?
Straight line.
Not streamline. Straight line.
Straight line.
Are there any other types of depreciation methodologies? Is one componentized or?
Back in a long time ago, there was component
That's
depreciation.
the way I learned it.
Yeah, that was a long time ago. And for some reason that became disfavored. And so they call it cost segregation now as opposed to component depreciation.
So now if I own property, I have two choices I have three choices. Don't depreciate it all and be stupid. Straight line, because maybe I want it longer term. Maybe I don't want to.
Maybe you like paying taxes.
Maybe I like paying taxes. Maybe I believe that cost segregation is too expensive on a single family residence. I don't know.
I would think most people would think that way.
That's what they do, and that's where I'm getting to, because that's what I believed the first 4 years I heard about this. So then we have cost segregation. So that's a depreciation strategy or type. Do you know which one?
Cost segregation is an approach or the acknowledged way the IRS allows you to write off more quickly.
So I had heard it originally as componentized depreciation, but now it's considered cost segregation.
Correct. Yes.
Okay. So cost segregation. I did not mean to interrupt you, but I just think it's very important. This is for you, Jennifer. You're always telling me I need to tell people about the tax thing because I get so excited, and I really do. When we first met at the board, I'm like, oh, yeah, I just love this stuff.
I just think it's like, I think this is the first time on the internet somebody's been this excited about taxes and segregation of costs and whatnot.
I make an F ton of money, and I don't have to pay taxes.
I get it.
But the trick is, it's not a write-off. It's not what I started when I was a kid in business of, I'll buy your bar tab because it's a write-off.
Which is the stupidest thing I've ever heard in my life. But yeah.
It is, but we all do it when we first get into the business.
Well, because like people don't understand that
it's an expense. It's not a write-off.
Yeah,
it's an expense.
For 3 seconds, a detour, just because we all have those friends like, oh, it's a write-off. You could pay for it. It's like, yeah, but somebody still had to earn that.
Yeah.
So
You had to pay. You had to earn $100.
Yeah.
To now you're.
So that's the biggest key on this that I wanted to touch on. That's an expense.
Yes.
This is a write-off that comes from an asset.
That's appreciating.
It's just once you learn this, I mean, it's just exponentially powerful.
Right.
Because if I buy a bar tab and get to write off $100, that money is money I never get back.
Right.
If I buy this real estate and write it off over 5, 10, 5, 7, 15, 17 years and sell the real estate, I get all that money back, plus the appreciation, and don't even have to pay the government back what I wrote off. So anyway, I keep interrupting you, but I get excited. I'm sorry.
No, it's no problem.
Can I be your salesman?
I'm hoping you are. I'm hoping you are.
All right. So anyway, I interrupted you at the
15 year.
15 year. You said the driveway, the swimming pool, the conduit. Yep.
It's now,
we were like hanging on every word.
Well, not only the conduit, but the soil that got compacted to go around the conduit. It's insane, but that's how detailed our reports are. So then getting inside of the property, so the IRS says the building, to be a building, has to have certain pieces, components, structural components is what they call it. So you have to have walls, windows, doors, roof, HVAC, plumbing for a bathroom, and electrical for lighting. Well, you have to have one source of light in the building. You don't have to have multiple sources. So if you look around the facility we're in right here, there's multiple sources of lighting all over the place. One would be considered primary, or for here, 39 year, but in a home it would be, or a rental property, residential would be 27 and a half. But then you've got sconces, and you've got chandeliers, and you've got recessed lights, and you've got all kinds of other stuff that can go into the 5-year property. You've got the whole kitchen space will go into the 5-year property. Everything from basically your cabinetry and your flooring. And
Can't stop you there because this is another cool thing. Flooring. I buy the house. It has tile floor. I rip out the tile floor and then put new tile floor in. What do I get to depreciate?
Okay, you would get
because I dispose of the tile that I bought.
Okay, so the pro tip here is you rent it out for a while. Okay, you don't immediately come in the day after you buy and tear everything out. Okay. The pro tip is you rent it out, let the current tenant stay in for a while, or you rent it out for a year, and you allow it to become yours, and you put it in service without ripping everything out. Then the next tax year, you go ahead and rip stuff out. So that original tile floor had a value and it was in service, it was used. It wasn't like it was all broken and dangerous, so you must have replaced it. You decided to do it later. Well, you get to take an abandonment loss on the original value of the floor going in, and now you get to take an accelerated depreciation on the new stuff you're putting in.
So let's pause there because, like, I think because what I'm hearing, if I'm hearing correctly, is if I buy a rental property, I should not update it, at least at first. I should try to get a tenant in as fresh as possible, let them live in it, and then after a year, then update it.
Well, maybe not, but if you have the opportunity to buy maybe a turnkey rental instead of, or maybe a lot of times in our house buying days, the tired landlord would call you up and they want to sell the house. What he's saying is instead of kicking the tenant out first, let them stay a while, get it in service.
Season.
Yeah,
Wait,
to the next tax year.
collect some rent.
Yeah.
Is the bottom line, and maybe
And you're not a CPA, or you
I'm
are
not a CPA, but
this
I've
is
worked with those
in
guys.
practice of what you've seen other investors do.
Oh,
You're not
well,
giving tax advice,
I'm not giving tax advice.
but this is in practice of what you've seen other investors do.
Correct.
Yeah.
And so what you want to do is you want to make it functional and paying rent so it's in service. And by the way, as they say, if you're a hammer, everything's a nail.
Yeah.
So I look at everything from a tax perspective, which is not necessarily the best perspective if your investor needs to immediately update the building. Right. So that's a whole different conversation.
But it's still an arrow you can have in your quiver, because if you buy a house in June or July and say that what if the seller wants to lease back for 6 months? Bingo.
Yeah.
Right.
Yep.
Well, just because you don't use a strategy, it's still good knowledge to have.
It's a good thing to tuck away.
Well, like I know if I eat salads and grilled chicken every day, I'd be healthy. That doesn't mean I have to do it.
No, I mean the barbecue we just had was so much better than a salad and grilled chicken.
You know?
There was chicken in there,
But I know
it was
there's
smoked.
knowledge.
It was covered in
But you
carcinogens.
can have knowledge. I mean, again, it's the pursuit of knowledge. Like this is like I've never knew that this was a strategy that one could use. You know.
So what's really good is if, for instance, you're buying a house and the roof may not be up to your standards. Let's say you want a roof that you don't have to think about this property. You don't want to worry about it, think about it at all. But you buy it and the roof is keeping the place dry, but now you're ready. It's 15 years old. And in your normal course of business, you would strip it off. Well, what if you waited a year or two because it was functional, as opposed to coming in and immediately stripping off that roof, let it sit. And that would give you the ability to take a write-off.
But let's get into the specifics of it.
Sure.
So, because I understand depreciation, or at least academically.
Yeah.
I buy a property, and the roof, it needs replaced, but I can get by. The floor, it needs replaced, I get by.
Yep.
What is the specific? Because you said something about abandonment or whatever.
Yeah.
What's the specific strategy? You go, okay, and let's talk about roof. Let's talk about the floor. Let's say it's the same property. The tenant does lease back for 6 months. What is specifically I'm supposed to be asking a consultant like yourself or my CPA or whoever? Like, what are the key words I need to bring up in order to make the most out of this situation?
So at that point, what you would be doing is you'd be putting the building in service, calling it, okay, I collected rent. So you tell your CPA, hey, we collected rent, we're good to go. And then the next year, you decided to redo the roof. Because here's what could happen. You could immediately buy that building, and the roof value, let's say it was just what we were talking about, and you're at a fork in the road, and you can either go down the road of replacing the roof immediately, or you can let it sit for a year. Okay, so if you go in and replace it immediately, well, I should say, let's say that we say that roof is going to be worth 30 grand, or that's too much for a $100,000 opportunity. So it's worth 15 grand, let's say. So the roof is worth 15 grand. If you immediately go strip it off and you try to tell the IRS when you're trying to take that abandonment on that roof, hey, the roof was worth 15 grand when I bought the building and I threw it away. They're going to say, Ryan, that doesn't make any sense. You immediately bought the building, and if the roof was worth 15 grand, you threw it away. Why would you do that?
Because they're thinking it's worth zero because
you threw it away.
You threw it away. Okay.
As opposed to if you let it sit, now you've used it, and we come in and do the cost seg, and we put a value on every single item in the building. It's literally, on our side, it's as if we're coming in with a little price tag and putting price tags on every single light switch, outlet, roof tile, whatever you've got at that building, the compacted soil around the conduit, we're putting a value on all of that. So when it goes in a dumpster, it's like somebody is sitting there tabulating, roof was 15 grand. You took 1 year of 15 grand. So that means you're going to get a roughly $14,000 write-off of that original roof when it hits the dumpster. Oh, the floor, it was worth 5 grand, let's say. It goes in a dumpster. If you didn't already have it in 5-year property, because now we talk about bonus depreciation. So depending on the bonus depreciation level, if it was 100, if you bought that in any time from 17 through end of 22, you would have gotten 100% bonus on that 5-year flooring.
What does that mean?
Okay,
The flooring was worth $5,000 and I get 100% bonus. Let's make this the simple thing again.
okay.
I buy the house, I fix the house up, and I rent the house out. Let's forget the whole fork in the road thing.
Okay.
That you go out and the price tag you put on the flooring is $5,000. And you said that was 5-year property?
Yep.
What does 100% bonus mean to me?
Okay, that means, so logically, you would think, $5,000 in a 5-year property category would be roughly $1,000 a year.
Right.
Let's keep it simple.
Yeah.
So you would think, I'm going to have to write that off over 5 years.
Right.
Well, in 2017, at that time, the new president because he might have been a real estate guy, I've heard.
The same new president we have today?
Yeah.
Oh, okay.
45 and 47. Yes. So what ended up happening was he put in a new law, a new provision in the tax code that said, hey, wait a minute, as opposed to waiting 5 years, Tim, wouldn't you rather take that immediately? So he enacted a new rule that was allowing bonus depreciation, meaning you could take everything that is recategorized into 5-year and 15-year in the first year. So you would get to take 100% of that 5-year asset the first year. So you would get an immediate $5,000 deduction on that flooring that otherwise, if you didn't choose bonus or if bonus wasn't in play, it would have been written off over 5 years.
But so bonus, I've heard people explain this wrong. This is why I'm making you go through the simplistic way. Bonus doesn't mean extra. Bonus means you can do it all in 1 year instead of waiting the time. Right? So it's not 5,000 plus still the 1,000 a year.
Correct.
It's all 5,000 just in year one.
You got it.
Right.
And it also applies to the 15-year property.
Yeah, because I heard someone explaining it one day and I knew it was wrong, but I was like, but is it? Because it says bonus, and bonus implies extra, like you get more depreciation. It just means extra year one depreciation.
Now I hear what you're saying and understand why you might think that it's something extra, and it's probably in DC. Those folks down there probably said, hey, this will sound sexy. Yeah. So you're right. It's not more than you would have gotten otherwise. Yeah. It's the 5 and 15 at 100%.
Just this guy was teaching a webinar trying to sell some BS like guru stuff. So I heard it and I was like, that's not right.
You were on a webinar?
Like, yeah, I listen all the time. I'm an information guy. I heard it and I was like, that's not right. But then I was like, or is it? Like, am I doing this wrong? Like,
I've heard so many people on the webinars and the ads that you see on, Facebook and the social media out there, and the stuff some of these people say. I'm just like, I can't believe they just said that.
One thing,
the damn internet.
While you were talking,
it's a fad.
It was. You were talking about something, and I think is a great segue to it. Is the importance of having strong team members, because we talk about all the time
every episode
all the time about how you surround yourself with people smarter than yourself. And I think having a baseline of awareness of what you're talking about and what you do is you have to have at least that awareness. But I think it'd be incredibly naive and stupid for me to think that I can do this on my own. It's like, but at the same time, there are people on the internet just like, that are just chirping that are full of crap. So like finding someone like yourself that's like, I know how to do this, and hey, is reputable, and can Tim sign off on this guy? Okay, that's why I need to go with somebody you. But like the things that you're saying, I'm like, there's no freaking way I have the time, the knowledge, or the patience to go through what you're doing.
I posted on Instagram yesterday. Everybody's always ditch your W-2, get out of your W-2, get out of your W-2. Like, it sounds cool.
Oh, I saw it.
Well, I mean, they announced that the Citigroup CEO just got a 1/3 increase in her pay, and she now makes $34 million a year. Yeah. And I was just kind of laughing, like, yeah, ditch that W-2, right? I mean, you know,
I'll take that W-2.
the whole point is like be careful who you listen to. I mean, typically the people saying ditch your W-2, number one, they don't have one, and number two, they need you to ditch it and pay for their course.
Well, for just 2 seconds, like in 2018, there was a guy on the internet on Facebook chirping about Bitcoin. And I'm like, back then, if it would have been anybody else talking about Bitcoin, I probably would have bought. But because it was that Yahoo, I was like, I'm not listening to that guy. Missed that boat.
But the reason I bring up W-2 very strategically, I am a real estate professional. So these deductions can go against my active income.
Yep.
And my passive or my passive income. Some people are not active, and I know you're not a CPA.
You know,
But you've probably heard people get disappointed because they didn't quite understand this. If you're not an active real estate professional as defined, by
the tax code.
yeah,
There's plenty of tax code.
well, I
about
almost
it.
said the tax code. I almost said check with your CPA because I don't want to get it. If your CPA can't say yes or no, you're an active real estate investor, you probably need a different CPA. And I'll tell you why. And I am going to let you talk in a minute. I promise.
I don't believe you.
A young man I coached as a little league football player is now in the NFL. And he and I were talking recently. It's all my coaching. Clearly. He and I were talking recently, and he's a real estate investor now, and he's doing some private money lending. And I get all jazzed up about depreciation. And he's like, well, my CPA said I can't do that because it wouldn't offset my NFL salary. And I said, dude, you need new advisors. Because I'm just going to give advice, even though I probably shouldn't. It is not hard to form a single member LLC and perform real estate activities enough on a monthly basis in order to meet the requirements per the tax code. And too many people accept no and don't ask, okay, but how, right? It's yes, if you are not an active real estate investor, you cannot take this depreciation against your active income. But ask how to become an active real estate investor. I mean, document your time. Get the little app thingy. Yeah, I'm like, dude, you're doing private money lending. You're spending time running comps. You're doing this. You're doing this. You're doing this. You've got off season. You've got. I mean, like, there is a way. You just have to ask, okay, great, Mr. and Mrs. CPA, you said I'm not. How do I become? Can my wife become?
That's a good
Right?
real
Like,
good
I mean,
way right there.
Because my wife is a licensed real estate broker in the state of Texas. We own a real estate brokerage. Guess where the depreciation flows through to our 1040?
Your personal return.
Yeah. So against my active or passive or both?
Well, it would be both because of, well, either way for you two.
Yeah. And you're not a CPA, but damn it, so you know what I'm talking about.
I know what I'm
right?
talking about. And
I'm in the 38% tax bracket, Jeff.
I'm glad to hear that. So you need
Actually,
cost
I'm in the 0% tax bracket now. I get happy, sorry.
It's a great topic to get happy about. On that note, typically the hurdle is 750 hours a year of focus on real estate stuff. If you've got a spouse that is in the real estate world and she manages your contracts and negotiates and does the stuff that goes along with it, then you're really good to go. No matter what, you're a brain surgeon or you're doing other things. I've had situations that a client made a lot of money as truly a brain surgeon, and yet he couldn't claim real estate professional status because he made so much in brain surgery, but his spouse was managing their portfolio and doing the negotiations with the tenants and all of that. And that's a really good tool to use and to understand. So that could work very nicely there.
Do you know what 750 divided by 52 is?
I think it's about 15 hours a week, but I may be off on that a little bit. It's not a lot, especially if the person's truly doing it.
And it doesn't say per month.
No, you're right.
It doesn't say per month.
You're right.
So if you're a teacher, a firefighter, an NFL football player, there's a couple months where 40 hours a week would be 160 hours a month, right? And what's 160 times 3? I don't know. 450? What was the number?
750 hours.
So now I'm only 300 short.
Yeah.
Now I got 300 divided by 9. I got what? Help me out. 30 hours a month that I need to do. I mean, so
If you have if you have a 30-minute commute, maybe you drive differently and you're looking at properties. Is that considered real estate?
I mean,
Professionalism?
now you can now you're starting to get into splitting hairs, which
we're not going to do on film.
yeah, exactly.
Hypothetically.
I mean, look, if you've got documents and you've got a real estate email account, then you're getting daily emails on different notes that you've originated, different property management statements. If you're being asked to inspect things or review things, I don't believe it is difficult to quantify an active effort. There's no timesheet required.
So I think the important thing in this conversation is realizing that the taxes are a game. And there's a lot of aspects of the game that most people don't realize is an aspect of it, because we just think in terms of, I have a W-2, I do my little tax form, maybe I have some deductions. But when it comes to real estate, I think too often maybe they take that same mindset, do the straight line, and what, if I'm hearing correctly, is like, hey, you just keep going and just keep finding different holes that you can, or not, is it holes or loopholes or however you want to put it?
Okay, so
Rules, yeah.
rules. You can use the tax code to your favor or not.
Right.
I would steer you away from the word loophole, because it's not like they left some weird little opening in the tax code accidentally. It's a big part of the tax code.
Right.
So it's not a loophole.
In the state of Texas, when you drive on the highway, there is a minimum speed and a maximum speed. And you're allowed to go any speed in between. And that's my entire metaphor for this. The tax code allows me to either not write off the depreciation, to do straight line, or to do a cost segregation study, and then do the rule by the years that it says each component is worth.
Yes.
And I can choose which part of the rules to follow, as long as I'm following the rule.
Yeah. You can choose not to take part in cost seg or do. To go back to your comment, Ryan, about it being a game, it kind of is a game. And my analogy or metaphor is kind of like Monopoly. And my bet is anybody watching this show knows Monopoly the game. And within that game, there's that rule that as you're going around, you get to pick up $200 when you go around go. And if you miss it, the rules say you're not supposed to be able to come back and say, oh, hey, Dad, I forgot to pick it up my last go round. I'm going to take it now. No, that's not the way the game is supposed to be played. It's if you miss it, you miss it. And that won't kill you to not pick it up, that $200. It won't kill you as you're going along. You'll keep going, and it won't hurt you until you're maybe 6 times around and you've forgotten about it 6 times, and you end up landing on Park Place or Boardwalk, and there are hotels or houses there.
And you're
now,
$100 short.
Correct. So that's when it'll kill you, is not right away. But if you don't take advantage of the rule of picking up that $200, you're out of luck later. Okay. And so that's my metaphor is it's part of the game. It's part of the rules. Why would you not grab the $200? Because my bet is both Tim and Ryan would rather have that money, whether it's $200 or 20,000 or 200,000 or 2 million, whatever it is, you can control the destiny of that dollar versus sending it to DC and letting them decide where it goes. You get to go buy another property, or maybe you can take that money and fix up the current property. And guess what? Now you can charge a higher rent because you've fixed up the property. So if you know the rules or surround yourself, as you were saying, one of you were saying about how it's about your team that you put around you. So this is what I've been doing since 1999. Our firm started in 96, and it was an engineer and a CPA back then. I joined in 99. We were doing about 5 to 10 projects a year in 99. We ended up doing a seminar for a bunch of CPAs just outside of Boston. And we went, at that time, we had 85 CPAs come to that seminar. We went from doing 5 or 10 projects a year to doing a couple of hundred. Now we do a couple of thousand a year. So We go all over the country. We have 6 offices. We do everything from little Airbnbs to big skyscrapers, and everything in between.
Now, what you're talking about, are you specifically real estate, or do these strategies, is there ways to do them in other aspects of business, or is there, like, where's the limits of this conversation?
So that's a great point. And there's all kinds of different little tools. It's kind of like the Swiss Army knife. You know, you've got the red thing, and it's got a spoon on there and a fork on there. And so the tax code has a whole bunch of stuff that you can use. So cost seg per se is a real estate related thing. But there are other things that your accountant wouldn't need a cost seg for. So like if you bought some equipment for your building, for your manufacturing company, you don't need a cost seg for that equipment because the tax code's real clear. That would be a 179 deduction. So you don't need us for that. But there are pieces of the tax code that also would play in down the road.
So as we wrap up, I was told for the longest time it is too expensive to do this on single family. It has to be commercial or multifamily. What's it cost on the average single family home to do a cost segregation study?
That's a big possible.
Now, we won't have time to get into this, but I use the QIP.
QIP because it's 39.
Yeah.
So it should be done on 39 then. So but go ahead.
But I put $250,000 down on a $750,000 house. I mortgaged $550,000 of it. It's worth $1 million. My year one tax deduction was $713,000. And because of like all the furnishing and I don't know. Bottom line is I paid like $4,500 for that report, and I wrote off $713,000 in year one. And in the 38% tax bracket,
It's a good write-off.
and the beautiful thing is it carries forward. So even if you do hit a home run deal like I did and you didn't have that much income to make go away, guess what? It's a beautiful thing to wake up on December 31st, on January 1st and know the first X number $100,000 I make this year is tax-free. And that is the way I'm going to wrap up. If people want to get in touch with you, we'll put it down in the notes and on the screen and stuff, but do they call you direct or
You can
what?
call me direct, JDH at Cost Seg Studies.
Yeah.
I'm also on Instagram as the Depreciation Doctor, on Facebook as well. So every Thursday is Thorsday, my dog. Thor is a Black German Shepherd, and he goes around and helps my clients find tax deductions. And so every Thursday is Thorsday.
Well, I love the IRS because I just play the game within the rules they give me.
There we go.
Hey, I appreciate you being here, man.
Hey,
Good
man,
meeting
thank you. I hope I didn't run long.
No,
Me
it's
too.
perfect. You good?
Gives there.
That's it for this week. We'll see you next week.